What's Making Headlines? Your weekly wrap-up of the biggest news stories in the Australian mortgage and finance broker market.
Hello and welcome back to What's Making Headlines. It's Annie, Ben and Charlie here with you today, unpacking the news of the week. Ben, how's your week been so far?
Yeah, really good, thanks. Rate week, rate decision week, which is always massive for us. But
First rate decision of the year. It was very exciting. We actually had some good fun in the office going around with the social media team, asking everyone what they thought rates were going to do. Nearly everyone said hike. Charlie, you wrote the story though. What happened on Tuesday?
Yes, the big news of the week, what everyone's talking about, and it was widely anticipated. Treasurer Chalmers made reference to that it was widely predicted, but still not good news nonetheless for borrowers. But the RBA indeed did hike the cash rate by 25 basis points, taking it from 3.6 to 3.85%. And Michelle Bullock made reference to the fact that inflation is far too high for the RBA's liking and insisted that the bank needed to act before it got out of hand and out of measure, and that they needed to intervene. She was pretty stern about that. They haven't raised the cash rate since November 2023. So it's been a long time. It's been over 2 years.
Yeah. What a beautiful 2 years it's been.
Well, a lot of people didn't think we'd be in this position so soon again. And now everyone's debating if it's another tightening cycle or if it's just an adjustment.
Yes.
There's a lot of talk about that.
Lots of talks about that. Well, I think we'll talk about what the other lenders think in a second, but I think that the other thing that everyone was sort of looking at was the quarterly statement, because obviously while they put out a monetary statement each time they make a policy decision, the statement of monetary policy only comes out once a quarter. So I think all the economists and most of the markets, to be honest, were pretty interested in what they had to say in that, because as you say, in the run up to it, and we talked about this last week as well, was everyone was sort of being like, probably going to be a hike. They probably want to cool inflation given the new figures and the unemployment figures. Yeah. And that was pretty much what they were saying. But the statement of monetary policy itself had some changes in it, which I thought were pretty interesting. What do you guys think about the shift in the forecast from the RBA?
Well, there's a lot to digest. And I guess we can start with inflation, because that's on the forefront of everybody's minds. And that has changed. I guess firstly, they're walking in with the assumption, technical assumption, that there's going to be 60 basis points of rises this year.
This always makes me laugh, is that they go, this is what the market is pricing in based on what they think we're going to do. And so here's what our forecasts are based on what the market thinks we're going to do.
Stop myself and think when I was writing that.
Yeah, you're like, what? 60 basis points rise? You're like, that's what they think the market's going to do. Oh my God.
Hold up. Yeah, exactly. Bit of a disclaimer here for the RBA. But still, nonetheless, that's what they were pricing in re-rates. But in terms of inflation, the bank is now forecasting CPI to peak at 4.2% in the middle of the year, which is up from their 3.7%
quite a bit up
forecast. So that's a 0.5% increase. Yes. So up quite
about 5%. We've been real problems.
Yeah, no, 0.5%, make an emphasis on that. And they believe trimmed inflation, which is obviously the RBA's preferred metric, will also peak at 3.7% in the middle of the year, up from 3.2%, so another 0.5 increase on that metric as well. Then they think moving forward, inflation will drop to about 2.6 by June 2028, which is the end of their forecasting horizon. But that's quite a while away. That's about 2.5 years away for inflation to come back down into their band, and it's still quite high. A lot of the banks made emphasis that 2.6% is still quite high for their liking, and it's not as low as the RBA and certainly no one else.
And it's a shame that's been pushed out again, because I think last time we had the statement of monetary policy come out last quarter, they were saying mid 2027 to late 2027 for inflation coming back down. Now they're saying 2028, so late 2027 into 2028. So constantly pushing that horizon out, which is obviously not great news for those with their mortgage.
No, it's obviously disappointing for everyone, for the government, for borrowers as well. It's a pretty I guess rude shock for the government as well, because we all thought that this inflation fight was well behind us, and now it's creeping back up again.
But yeah, it is interesting, and some of the language has sort of been used coming out of the decision. I think the big question is whether this is going to be part of a new tightening cycle, or whether it's sort of a one and done sort of rate cut. And I think that's kind of what everyone is trying to figure out at the moment.
Yes, well, because of the statement, I should actually say as well, the vote was unanimous from the RBA Monetary Policy Board. So no one had any qualms about what they were doing. They were like, let's cut it now. Let's try and get ahead of this. Let's try and cool things down a bit. But after the statement of monetary policy came out, the lenders, as they always do, were revising what their forecasts were. And they were saying, based on the language, based on the change of forecast, based on the fact they think it's going to take longer, a couple more major banks said, we think there'll be another cut. So they were like, if they want to achieve what they want to achieve, and they think inflation's going to hit this peak in mid-2026, they were like, we think there'll be another cut before then. So both CBA and also Westpac came out and said another rate hike in May.
Big news.
Yeah, so that's pretty big news. So NAB was the first one that had said 2, and they, I think towards the end of last year, were saying Feb and May. Now CBA, Westpac have joined them. So ANZ's the only outlier that hasn't yet updated its forecast.
Definitive call pretty early, don't you think?
Yeah, they did make that call early. I think CBA and Westpac were like maybe a long, prolonged pause after a first hike, but now because of the updated statement, they're like, nah, second hike in May. So I did have a look at ANZ's forecasts as well, and I couldn't find one that had come out after the statement of monetary policy had come out yesterday afternoon. Tuesday afternoon.
Tuesday, it feels like a long week.
I don't know what day are we on today? On Tuesday afternoon, but I think the thing that I had seen that day after the rates came out, so between 2:30 and 3:30, they were like, we think still it's going to be a sort of prolonged
status quo.
Yeah, exactly. A prolonged one. I'm actually just going to look up the language they use. So they said, Adam Boyton, who's the head of Australian economics, said he expected that really, as a result, while the RBA's base case might be that another hike is more likely than not, they think that the action from this week should be enough to cool things down. He said risks are clearly skewed to an additional hike, given the RBA's focus on capacity being behind the lifting of inflation from the second half of 2025. But he was like, but still, we think probably just going to be a little bit better than the RBA thinks. So he's sort of suggesting, we reckon they'll be pleasantly surprised, and then actually they won't have to do another one. So fingers crossed.
Hopefully, yeah. And it's interesting as well to see how much the new quarterly statement on monetary policy impacted CBA and Westpac's shift as well, because I remember Westpac was pretty insistent that it was going to be an insurance hike and a one and done hike, and that was the language that they were using in their commentary. And obviously these new forecasts were enough for them to tweak things.
Yeah, feel confident enough.
I think it's the figures are pretty important here as well for the bank's thinking.
Yeah.
And also, the labor market and wages, those were also made reference, and some surprising things as well for the banks on the labor market, that they think it's going to drive higher to 4.6% by mid-2028. I know that's a very far while off, and it's going to relatively hold steady, but the bank was saying that they didn't think that it was, in their prior statement, they didn't think unemployment was going to be that high in 2028. They thought it was going to be at least 0.4% lower, and also wages as well. You've got real wages that are not going to turn positive until mid 2027, according to the RBA. So a couple of big updates here.
Well, I'm sure Michelle Bullock will be unpacking all of that, because she is fronting the Housing Economics Committee this morning. I did see her opening statement before we came online. Yep. She was talking about, obviously, her the rate decision this week and her sort of forecasts for the economy, basically being like, we thought monetary policy was restrictive. It turns out, looking at things like housing credit demand, looking at things like inflation, it shows that maybe things aren't restrictive. People are still spending quite a bit, so we had to hike. And I'm sure she's going to be asked a lot about that over the course of today. And I'm sure loads of people will be trying to press out of her the actual forecasts for, when they'll be hiking rates and what that will be doing. But she was pretty sympathetic in the opening statement, being like, we know that those with the mortgage won't love this, basically. And,
obviously,
it's going to cause some pain, but she's like, but it needs to happen for demand to come down.
Yeah, it does.
She did also, which I thought was pretty interesting, apologise for the RBA outage that happened on the 27th of January, which actually meant that some property settlements didn't go through. So that was pretty interesting. So she actually did apologise this morning to the Economics Committee and well, obviously to the broader public for that outage and for those who are impacted. So if you were a broker that had a client impacted by that outage, do let us know what happened. Give us some thoughts on what you think can be done to try and prevent this from happening in future, because that's a big problem. We'll take a quick break here. When we come back, we'll talk about what's happening over at the financial regulator, a couple of big announcements from them this week, and we'll get into it just after this message. So speaking of things that we have kind of been catching up on, we did have some conversations with brokers this week around ASIC levies, because the regulator has started issuing the invoices for their regulatory activities in FY25. As we know, they always release an estimate, a CRIS, as they're calling it, where they kind of estimate in the first half of the year what they think they're going to be charging industry for the pleasure of being regulated by them. And then they start issuing final invoices in January to March. So they've just started coming through. And we had some brokers reach out to us and be like, these invoices are way higher than we were expecting. Why? So I went and had a little look to find what the reasoning was and tracked down the final costs from ASIC of what it's going to be charging everyone. And interestingly, credit intermediaries, which includes brokers, will have to pay 37% more than they originally estimated. Now, this is always so annoying for brokers, for the aggregators and brokers, because how on earth are you meant to budget for this when you have no idea if they come out with one estimate and then it's more than a third higher when you actually get the bill? Like, it's so annoying.
How much does it work out brokerage by brokerage?
So it's not a lot. I think for most, I mean, if you think like the whole entire sort of credit intermediary section, so the broking industry will pay a total of $8 million in levies, which sounds like quite a lot, but actually in the general kind of gist of what everything isn't. But when you think that's up a third, that's quite a substantial increase. So I think it was, and even from last year, for example, they only paid $6 million. So this is going up and up and up. And I think the part of the issue really was that they were saying there was increased enforcement action. So, obviously when they do their estimates, they're going, this is what we know we have in pipeline, but some things might crop up that are either taking longer or more costly to enforce, or they just have more things than they thought they were going to. So a 40% increase in enforcement action. So that was $2.3 million. And they were saying, and new matters arising.
Gosh.
Now that caught my eye. I was like, what does that mean?
More to come.
Are we expecting lots more enforcement action exactly this half of the financial year? Because we haven't seen it. So we always obviously release news updates when ASIC does take action against the broking industry, whether that's banning someone or, taking someone to court, or even if the court jails them. But we haven't seen that much change in the last 6 months from ASIC around enforcement action in the broking industry. So the fact that there's new matters arising concerns me a little bit. I'm like, what is this? We do know that ASIC is undergoing a best interest review at the moment.
Yeah.
So maybe it's from that. They've been also looking quite closely at car financing, and that includes people who are offering finance at car dealerships who fall under the credit intermediaries section. So it might not actually be brokers. It might be people working in car dealerships. So yeah, we've got to wait and see. I expect we'll have some flashes from ASIC in the next few months, weeks and months, as we kind of find out what this costs actually are. They also said that industry engagement was 43% higher, and part of the reason.
What does that entail?
Yeah, I don't know why that'd be so expensive. Like, why? Surely just a meeting are you charging people for that? Like, I don't understand why it's so expensive. 43% higher, more engagement. There's also more spent on digital data and technology.
Yep.
And I think other sort of things that were supposedly costing them were property and accommodation services. I don't even know what that means. But yeah, so looking at issuing those levies, there'll be a minimum levy of $1,000 plus $89 per credit representative. So I had a little chat with Greg Ash, who's the director of risk management company QED Group, and he was saying basically why on earth have these costs gone up so much? Particularly, it's almost tripled from last year. He's like, we haven't seen an increase in regulatory action. Why is this happening? So he was like, what are they doing with this money? And,
it's a good quote. What has ASIC done with our extra money?
What's ASIC done with our extra money? It's like, we haven't seen a tripling in regulatory activity. We haven't seen that. So
question.
Why are they charging us all this money?
Exactly.
A great sort of quote from him. And he did caveat that by saying, I'm sure they're doing plenty behind the scenes, but from what we can see from the lenders, from the aggregators, and from obviously media, like, there's not that much that accounts for it.
No.
Yeah, maybe something big is coming.
I know. Gotta watch his space. I feel like it must be, because there's nothing that we've been writing about recently that would warrant it. The other big thing we had from ASIC this week was their new chairperson. So ASIC's been around for 35 years, and over that 35-year history has had, I think, nine chairs.
9. Yeah.
And this one, the first woman, hooray. So Sarah Court, who is the deputy chair of the financial regulator, stepping up to become their first female chair, which is exciting news.
Very big milestone.
Hooray for women in finance.
Absolutely.
So she starts on...
She starts on the 1st of June.
Thank you. I was like, is it May or June? I can't remember.
Joe Longo's wrapping up his tenure. He's been in the media a lot. He's been doing a lot of speeches, announcements, talks, and he officially concludes on the 31st of May. He commenced his term in 2021. It seems ever since I've been in the media that Joe Longo has been in the scene, and especially late last year with ANZ, we saw a lot of him as well with those big fines that they
Record
received.
Fines,
he was up on 7:30 and whatnot, front facing for the financial services regulator. So
because I think they have 5-year terms.
5-year terms,
when they become chair. So he has been around for a while, and obviously 2021. That was quite an interesting period. That was the first year we had the best interest duty come in. So he was really at the forefront of that, looking at how they were engaging that, the guidance they were providing brokers when bid came in. He's been through all of the kind of, different changes of things like the speed limits coming in. Yeah, lots of different things that he's been sort of spearheading over the 5-year period. So we're interested to see what Sarah Court gets up to.
Yeah, she's kind of a natural successor, being the deputy chair since 2021.
She knows the deal already.
Yeah, and she was commissioner of the ACCC as well, so has heaps of experience.
And that actually is quite interesting seeing, she's got competition experience. Like, is she going to be really having a strong focus and taking ASIC and making sure that the financial services market is not only running in a compliant way, but also maybe in a competitive way? I wonder how much of that will influence her chairwomanship. Chairship. Thank you.
I don't know if that's a correct word, actually.
So I think that's another sort of big thing from ASIC. And you mentioned earlier, Charlie, some of the pre-budget submissions from the groups in the broking market. So let's delve into those, but we'll take a quick break before we do. So the budget is only a few months away, and as is always the case, the Treasury will ask for submissions. They've released a whole bunch of them. I think they were like 800 or something crazy that have been released, and including amongst them some from the broking industry that we have had a little read through. Charlie, you were delving through the many, many pages of these submissions for the budget.
Riveting stuff.
What do people want?
Well, let's start with the Australian Finance Group, one of the nation's largest mortgage broker aggregators.
Oh, a little plug for them there,
their submission was titled Sustaining Competition in Australia's Residential Mortgage Market, and maintaining competition in the market was really just the central theme of the entire submission, really. They made reference to the fact that, brokers now represent a very, very, very sizable chunk of new residential mortgages, which is 77%.
According to the MFAA.
Yep. And they also made reference to the best interest duty in place since 2021. And they pointed out that the regulatory regime, the current regulatory regime is fit for purpose and working in the interest of consumers. It demonstrated that. And on the basis of that, they want the federal government to protect the current regulatory framework, including the best interest duty, and to really steer away from reforms that would undermine the broking channel, undermine the kind of current system. They're happy with things how they are at the moment. So I'm talking about the major banks and the advantages that they enjoy compared to, non-bank lenders and whatnot.
I did think it was interesting seeing from AFG as well the commentary around competition and lending.
Yeah.
And of course, AFG, as we know, has its own funding line arms, AFG Securities and AFG Home Loans. So they kind of securitize through AFG Securities, and then they package those up and distribute through mortgages under AFG Home Loans. So, of course, they're kind of saying, well, we'd like to make sure that the securitization market is doing well and that non-bank lenders are faring well and don't have any kind of untoward regulatory pressure.
Yep.
Obviously in their interest to say that.
Absolutely.
But yeah, I thought that was pretty interesting. And this has been a conversation we've been having for a long time around aggregation and lending and whether there would be any more scrutiny of how aggregators are distributing their own manufactured products.
Yeah.
Because as we know, there's been a lot of focus on conflicts of interest in the past. And they were saying, some people are saying, well, is it right that an aggregator actually manufactures their own loans and then gets their brokers to write those loans?
Yeah.
Like, doesn't that feel a kind of like a conflict? But they have had on their board Greg Medcraft, who used to head up the financial services regulator, and he's been at the forefront of securitization. And you'd think if he was on their board and kind of talking about this, then it would be legit. But yeah, of course, that's a big thing they've been talking about, and they kind of called on the government to take a look at that and make sure it was working correctly. Is that right?
Yeah, they called on the government to, quote, examine mechanisms to improve non-major lenders' access to competitively priced funding. So including pretty targeted, competition-focused funding on securitization, where market shortcomings were kind of arising.
Yeah.
And in those, they offered 3 recommendations conclusively to the government, that being, as I mentioned at the start, to safeguard the current system, the regulatory system, and the BID, which they said is delivering, quote, strong consumer outcomes and housing affordability and cost of living relief through brokers. And avoid regulatory changes that would disrupt the broker channel. And also, on that last point that you and I were just talking about, examine options to improve access to competitively priced funding for non-major lenders.
Pretty broad recommendations here.
Yeah.
Not really asking for anything specific.
No.
It's been like, we like things as they are, thanks.
Yeah. And I guess they're doing pretty well. So.
Yeah.
No, there weren't many specific recommendations here. There were obviously specific recommendations in others.
Yes,
peak,
well, let's talk
peak
about that.
bodies
The
represent
Mortgage
brokers.
and Finance Association of Australia has released its pre-budget submission,
Yep.
and in that there is more detail, more specific requests. Quite a sizable submission as well.
Yep, very much so.
What are the headlines? Because I think they were 20 odd or something like that.
But they sort of led with the same idea that market share kind of displays the efficacy of the broking channel, at least at the moment. So kind of keep those things that are driving that going. Is what they're like.
And I think because the MFAA, and we've reported about it a lot on the advisor, is being like, they've put loads of submissions forward to different regulatory consultations, to Senate consultations. So there's been
ASIC,
to ASIC, So there's been a lot of submissions from them already on things to improve competition, and a lot of them have been repeated.
And they made mention to that too in this current submission that we have stated this here, we have stated that there at this hearing or at this submission as well, whether it be the recent ASIC one that was conducted as well. So a lot of points that are popping up and arising repetitively.
So one of the things that I think we've seen them write in the past in different submissions to the regulators has been like, can you make sure that lenders are... These are some of the recommendations, I think, from one of the banking reviews, is being like, can you make sure that lenders are discharging within 10 days? That's something that we've heard them make repeated requests for to government. They've also asked for more easy ways of switching. So again, one of the banking reviews had put forward these recommendations, which we still haven't had a government response to, other than, yes, we think they should be doing this. So there's, again, saying making switching more easy.
Yeah.
What else were they calling for, Charlie?
So they also want the consumer data right elevated from an optional tool to a core lending infrastructure.
Yep.
And expanding it into business lending to match its existing use in residential cases. And they put forward specific proposals, that being to expand available data sets, incorporate relevant government-held information like ATO records, and enable third-party consent arrangements. And they also made mention to the fact that regulatory costs should match the broker risk profile as well. So,
yeah, that's similar to what we were sort of talking about before the break. That's the SLR stuff. Where, there's
SLR, that's right.
We're not seeing a huge amount of activity coming from the broking industry yet. Why are their costs going
having
up?
to pay for them? Yeah, and we know, again, the CSLR is something that everyone's sort of been reviewing and looking at. They're talking about bringing in new industries to cover the costs because these costs keep going up and up and up and are expected to continue to go up. So as the MFAA has said there, and again repeatedly across the board, being like, don't make us pay for the failures of others. And also, I think calling for things like, making sure, again, like the AFG submission said, that just brokers are front and center. They're not being unfairly penalized. They're not being sidelined. That regulation is fair for them. And really backing what brokers do.
Yep, absolutely. Yeah, their CEO Anna Panak stressed that their recommendations and their consultation recommendations to the government were drawn directly from consultation with brokers working on the front line of lending markets. So these are things that brokers really want to see enacted and issues that they come across day to day. So yeah, very, very much so, all relevant for the industry.
And like you were saying, there's sort of a lot of these things are things the MFAA have talked about before or submitted about before. But I think as an industry advocate, you sort of have to keep
on saying it.
Keep on saying it, yeah.
I think the other things that I've seen from the pre-budget announcements, not necessarily from the broking industry, but I think more broadly that does impact the broking industry has been a call to make the instant asset write-off permanent. That's always something that comes up every single year because every single year they have to redo the legislation to extend it. So lots of calls for people saying make that permanent, please, and also potentially increase the amount available. The other big thing that people are talking about at the moment is capital gains tax. You would have been living under a rock if you hadn't seen all the arguments and discussions going on about CGT at the moment. So talking about should they be scrapping the 50% discount for investors? Should they be looking at negative gearing? And there was a report released by the Parliamentary Budget Office this week, which looked at what the costs would be of scrapping that. I think the Greens had asked them to do that as part of this big Senate inquiry they're having into CGT. So lots of discussion about would this be a good thing for Australia? Would it be a bad thing for Australia? Chalmers has kind of been saying we're really focused on intergenerational wealth at the moment. We're seeing the first wave of boomers retire. This money is coming from one generation to the next, but also being like, we've got a real problem with supply here. We want to be freeing up housing. Maybe we should be cooling off what investors are doing.
Yeah, it's not going to be the last we hear about capital gains tax this year, I don't think. Also, I don't have the figures in front of me, but were they saying it was going to cost a budget $250 billion?
Billion. Lots and lots.
Yes. So,
but it's interesting because I think like some of the quotes I've seen from different groups talking about this, obviously every time we talk about CGT or negative gearing, we get a million press releases from different people wanting to have their say. But one of them that caught my eye was around from Homelessness Australia, I think it was, and they were saying the New South Wales government actually spends more on discounts for property investors than it does on social and affordable housing and homelessness shelters. So they were saying that's not right. Something is wrong here. But I mean, it's a really tough one, isn't it? Because so much of our wealth in Australia is tied up in property. Lots of people have investment properties. If you start changing CGT for investment property, then that is going to cause quite a bit of kickback We're not in an election year though,
No.
so they've got some time to reel it back in.
Yeah,
They've got the time and a bit of a mandate as well, so they're probably going to start exploring these things. The instant asset write-off is an interesting one as well, because there always seems to be a bit of vagary around that every year. When that
Honestly, I think last year they only passed legislation to make it official for that financial year at the end of that financial year.
Yeah.
So, I mean, everyone assumed it was still going ahead.
just in time.
But yeah, if you're like thinking, if you're an accountant and you're talking to your clients, or if you're a broker talking to your clients about getting financing for assets and, you know, using the instant asset write-off as well, then you're kind of a bit like, we assume this is going to be right off. The legislation hasn't passed yet. And then like literally, I think 2 weeks before the end of financial year, it passed. So I think a lot of people are like, this is very annoying. It creates a lot of uncertainty, creates some stress as well. Because if you think that you might have assumed they were going to do it because they'd said so in an election promise, you know, a year earlier, and then they never actually enact it, you're a bit like, oh, well, now I'm stuck with this massive bill. So lots of people saying, just make it permanent, make our lives easier.
Yeah, I think they'd probably appreciate the certainty, I suppose.
Yeah,
even if it's not the sum they want.
Yeah, so I think the actual legislated sum is $5,000, and then they have to increase it depending on what it is for that year. So I think at the moment it's $20,000.
Yeah.
So that's why they're having to constantly redo the legislation.
Yeah.
Make it permanent. Reduce the spend on needless bureaucracy. But yes, that's pretty much it for us, I think. Those are the big stories. We have lots of other stories, obviously, that we've written about in The Advisor. You wrote a great one, Charlie, about ANZ's lending book going backwards. We've been looking at new appointments, including Rob Ryan and Adrian Cunningham, the two of the big aggregation leaders at Viking, who haven't taken on new jobs. We've seen lots of new changes with products as well coming out. So heaps of news to read on theadvisor.com.au. And of course, we'll continue to be delivering our coverage of the budget submissions, pre-budget submissions. We'll be continuing at what ASIC is doing. Maybe we can find out more about what those arising matters are. And if you've got anything that you think we should be writing about, do feel free to reach out. You can reach me, editor at theadvisor.com.au. Of course, both Charlie and Ben, all their contact details are on our website. And do reach out if you've got anything that you think we need to be knowing about, hearing about, talking about. We'd love to hear from you. We hope you have a great week, and we'll catch you next time for another episode on the Advisor Podcast Network.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs, and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.